Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. Nice to be with you again. Interesting Friday trading in New York where the market felt that there were signs somehow fictitiously that China was going to open up and remove its zero COVID policy, which would have been rather odd given that only a week or two before the president of China had said, we're sticking to our zero COVID policy. I'm not sure how some people out there feel things work in China, but I do believe that if the president says something like that and reiterates it, it's probably how things are going to be in terms of policy decisions. So it was all a bit of a nonsense. It reminds me of everyone talking about the US Federal Reserve is going to pivot. I said from the outset, even when people first started using that word, that this was a nonsense. It was never going to happen. But it works wonderfully, doesn't it, to create a lot of volatility in the market. I wonder who benefits from that. So I think sometimes perhaps the financial media gets a little bit carried away with itself, with various thought bubbles. I mean, I'm guilty of that too, I guess. But there was never going to be a pivot, and there's still a zero COVID policy in China, which is why we're probably going to see equity markets sort of be a little uncertain today after some Friday strength and initial Monday strength, and begin to roll over yet again. Now, it doesn't mean that in the US tonight there couldn't be some other discovered reason for the market moving higher, but I do think that overall the outlook is not good for US equities. Now, I've been saying that to you, and some of you are a little bit tired of hearing that from me, but we've been getting it right. We've been helping you. You know, how many times have I said we have the financial instruments and the financial markets choice of market to benefit from falling equities. So this is a fact of opportunity, not a fact of fear. And the other thing also I'd be looking for is this oil price to continue to rise. We've been calling that for a little while, and it is really gaining traction. If there's going to continue to be a war in Ukraine, and it's nice to see that there are whispers that Washington may be beginning to ask Zelensky to consider peace talks. We don't know how valid that sort of leak is, but that would be good news. But as long as there is a war in Ukraine, there is the risk that energy prices will again move upward. Now, I know they've had great downward corrections, but I would suggest to you it's part of the volatility and not necessarily a new state of stability. So we've also seen in the US that inflation is taking hold in producer prices widely, in services widely. We've seen wages start to tick up a little more aggressively in the US. There is evidence of a wages prices spiral now already having been established in the US economy. This is what's spooking the Federal Reserve. But what might spook markets and investors quite a bit is what I'm going to suggest to you now, which is that the Fed funds rate may be going to 7.5% before it tops out. It's currently at 4% after some very aggressive rate hikes by the Federal Reserve, and the chairman has said those rate hikes may slow. We may see one more 75-point hike, but I think that would be about it. We may already be on our way to only 50-point rate hikes moving forward. Chairman Powell wants to see inflation back at 3% or even 2%. So he's in no hurry to pivot or reduce interest rates. A lot of people have said, oh, the economic data is worsening. We forecast that. It most certainly is. Interest rates will continue to drive that economic data in a not too good direction. Now, I want to make a reference here to the 1980s, and everyone says, oh, but it's different now. I mean, throughout history, everyone always thinks it's different now. But they had inflation of 14%, And the Fed chairman of the time, Paul Volcker, raised interest rates to 20%. Now, if we only see a fraction of that response from the current Federal Reserve, and yes, that was 14% inflation, this is 8% inflation, but it could be going 9, 10% inflation in coming months if oil prices move back up on top of an already established broad-based inflationary pressure in any case now in the United States economy. Then interest rates are going a lot higher, and it is not an out-of-the-question forecast to suggest that the Fed funds rate may be headed to 7.5%. I actually think that can happen. I'm not trying to scare you to get the direction right or to wake you up. I actually think that could happen. And that's now my central forecast. So that's a pretty strong forecast. But if rates could go to 20%, even plunging the US economy into downfall in the 1980s, because they tried before that to get inflation down with small interest rate hikes, but the economy just struggled in any case by trying to be gentle with it from an interest rate perspective. So this time around, it really, if you listen to Fed Chairman Powell, he does sound a lot like Paul Volcker of late. So I think they have taken a lesson out of the history books, a page out of the history books, and they're thinking that the harder we go, the sooner we go, the higher we go now, the less chance there is of having to do a 20% Volcker type interest rate level. So they actually think they're doing the United States worker, consumer, investor a big favor by going over the top now. On Friday, Chairman Powell said probably the end peak for interest rates is considerably higher than where the market thinks it is. I think he already has probably a number in mind or an area in mind, but it's so scary, he's not going to mention that. So he's just going to say, oh, it's high, it's probably higher than where the market. He already has an idea of where it could be going. So I'm going to pitch 7.5%, which he couldn't come out and say to the market because it would cause market dislocation. That's why he's not naming the number that they might have come up with behind closed doors in their own research. So, as you know, we've been better at forecasting the US economy and what the Fed itself would be doing in the future than the Federal Reserve has. And so I would suggest to you that they will eventually come to a number something like 7.5%. Now, if I'm wrong by 100 points, that's still 6.5%. What if I'm undershooting and it goes to 8.5? I want to really put that in people's minds, because if something like that happened, it would really spook the markets. But wouldn't it be better to be spooked now and act appropriately and play defense for something like that in advance of it happening? Just as people should have locked in their mortgage rates a year ago, 18 months ago when I first suggested it. That would have been a better way to handle rising interest rates in Australia, for instance, and mortgage rates in the US are already at 7%. I think that's probably an indication of where the Fed funds rate is going. So do not underestimate the chairman and the Federal Reserve apparatus determination to stop inflation. Yet we have possibly not yet seen the peak in inflation, and even after that they still want to get it down to 3% or 2%. So how high do you think interest rates are going to go, taking all those facts into account and forgetting all that nonsense about pivot? It was like, whenever I heard the word, I actually burst out laughing. It didn't matter who I was, a big fund manager, other economists, media, it was just laughable. So be aware, the chairman made it very clear all along. He is not changing his tune. It's just the market wanted to believe, I don't know where they got their ideas from, to be honest, that there'd be some kind of miraculous pivot and therefore buy stocks. You know where they got it from? Because they just want to buy stocks. Because the funds management industry is now populated by people who believe all their job in the world is to buy stocks. So all their brains can see is evidence or information that would support their emotional career attachment to buying stocks. Hence, they tend to get it all wrong again and again and again. So get ahead of the crowd, the big funds management industry, get ahead of Wall Street. Understand the Fed funds rate is probably going to 7.5%, even though the rate hikes may reduce from 75 to 50 points and at some point to 25 points. It doesn't matter how negative the economic data gets at the moment. If that inflation number stays high, Chairman Powell will be hiking and bang, bang, bang repetitively. Where does that put equities? As I've been forecasting for a long time, after the initial 10% fall, I said we're going 20 to 30% lower. After the 20% fall, I still said we're probably going 20% lower. That's about where we are now. US equities are probably still headed 20% lower. This is a multi-year, 3 to 6 year consolidation correction of the US equity market with significant downside risks. I may be overly bullish in being as bearish as I am. There are considerable downside risks to the US economy, US asset prices, including stocks and property market. I hope that helps you. I hope you recognize that this is great news because it means there's tremendous opportunity in the markets at the moment. Thank you very much. Clifford Bennett, Chief Economist, ACY Securities. See you next time.